I made a video about dividend investing, and my main point of making it was that on YouTube, as you'd expect, hang on, I'm on YouTube, but as you'd expect, there was some misinformation about a lot of people that promote dividend investing don't know that. I'll stick with my example. A $50 stock, when it pays $1 dividend, it then trades at 49, and the dollar is paid away in cash to its investors. I just see so many YouTubers who don't seem to know that, and that was my point in making the video. I also made a point that dividend stocks, I don't want to say generally underperform the S&P, but I've looked into it this afternoon again, done a whole comparison of dividend stocks, and I do maintain that performance-wise, they underperform the S&P, and that does include all the dividends reinvested. And then the last point I made in the video was that it's a bit inefficient because you generally, unless you're in a tax-efficient wrapper, you lose a small percentage, 15 or 30% of your dividend in tax. It's not massive, but it's a drag. And when you're fighting the market, are you fighting the market? When you're investing, you want as little drag as possible. You want the lowest costs, the tightest spreads, and you want your dividends, if possible, without any tax. People get very defensive, especially people that think of themselves as dividend investors. So if you find the video, you'll see a lot of people kind of attacking me and a lot of dislikes. So I find that really interesting, and I don't mean to upset people. So I thought I'd give their comments we'd talk about the comments, because they're saying I'm wrong in my points, that a dollar is paid away and the share price goes down by that amount. They generally underperform the S&P, they're inefficient. Those are my points. So the comments back, and I'll comment on whether I think they are valid or not. Okay, well the first one was, I'm sure there'll be more, but the comment starts off with, most dividend investors know that they underperform the SPOOs, the S&P. Great, yeah, I agree. But, he says, or she, I'm not sure the gender, they like the cash flow. Okay, that's a great trade-off. You're willing to knock a bit of return because you like the cash flow. And just bear in mind, if let's say you just held the S&P, just as an example, as opposed to a dividend stock that, let's say, pays a little bit more, a higher percentage. So you can receive your cash flow in the form of dividends, correct? Or you could go and sell a stock. You know, a few, let's say you wanted $1,200, you could sell 2 S&Ps. It'd be more efficient because you wouldn't be taxed on your sale, as in, you know, the withholding tax on your dividend, and you'd have the same amount in cash. And obviously, if you're in the S&P, most likely you're outperforming your dividend stock. So that would be that. So I can understand if you just don't want to have to go in and, let's say the market's like down 2% or 5% this week or 10% this month, you would maybe it'd be psychologically challenging. Whereas if the stock's down but you're still getting your $1,200, you would feel better about it because your yield is up, you've still got your 1,200, and I understand it's kind of mental gymnastics. And I guess a lot of people would think that they're selling at a bad price, and they wouldn't want that. Especially say we go into a long bear market, and they would feel that they were selling at the wrong price. Whereas a dividend-paying stock, they wouldn't have to touch it, they wouldn't have to sell it, they would be receiving a dividend. And I totally get it. I agree. You're just trading the performance for that cash flow, which is fine, great. So that was some great points that this person made. The next one. This one's not correct. They're saying that if you have to sell stock instead of receiving a cash dividend, you'll end up with 0. Well, your dividend payment, if you're doing like for like, will hit 0 at exactly the same time. Let's say the performance is the same. Let's say your dividend stock performs exactly the same as your S&P. Well, if you get to zero in the S&P in terms of that you've sold shares, let's not pretend it. The S&P does pay a dividend, even though it's quite small. So you would both hit zero at the same time because your dividend wouldn't be enough, and you'd have to sell shares in your dividend stock, and you'd also have to sell shares in your S&P. It's just mental gymnastics that's being done here. You'd both hit zero at the same time, assuming the same performance, and more likely the S&P would outperform your dividend stock, so you wouldn't actually run out of stock. Anyway, so that one's wrong, in my opinion, and you can easily work out the maths on that. This one's also wrong. Price goes back up. No, it doesn't. If price, so your $50 stock pays your dollar dividend, and this person is saying the price goes back up. No, it doesn't. If this were true, you would have identified the infinite money glitch. Literally. So no, it's not true. It doesn't. 50% will go up, 50% will go down. That's not, you haven't identified an infinite money glitch. I can see where you're coming from, but it's not true. Reinvesting. This guy I thought was bang on. He just said it's all about your total NAV. Yes, absolutely, 100%. Totally agree with that. And the dividends, as we were saying, will actually be detrimental to your NAV if you were in a total non-dividend paying portfolio versus dividend paying portfolio. You just remember you have that drag, you have that tax drag, all else equal. A few people mentioned a few stock names. We'll have a look at those shortly. And then I quite like this perspective that someone made. They said dividend investing is cash flow investing. Yeah, it absolutely is. You get some cash flow, and the better your picks of your dividend stocks, the better your cash flow will be, because dividends increase year on year, and they tend to grow. And if you're able to not spend it and put it back in, you'll grow your pot. But just remember, even with dividends reinvested, it's nothing more than we've looked at the stocks that when you reinvest, and it's no silver bullet. And then this person said that stock investing, as opposed to dividend investing, is asset investing. And I like that kind of. It's a mindset, I think, that he's getting to on this point, because many stocks pay a small dividend. I think dividend investors kind of look for that 3, 4, 5% dividend, and then they look for that 5, 6, 7% dividend appreciation. And at the same time, they're hoping the stock price goes up. So they're looking for all three. And I totally get it that most of the theme on the comments is that if the market's down, you still get paid. That's assuming they don't cut their dividend. But that's where it'll be up to you to pick those good ones. So great comments. Some of them I feel are a bit off, but I kind of get the point behind what everyone's saying. Some of them I think are mental gymnastics and not entirely true. And some of them were spot on. And I totally get that dividend investing is almost a bit of a faith. And people obviously get very protective in that. I follow various dividend investors that really like the kind of process of these cash payments. They use it in their retirement. They don't have to sell anything. I get it completely. I really do. So my main bugbear was that so many YouTubers don't seem to understand that the cash is paid away and their stock goes down in price. That was my main point of making the video, and just to make sure people knew that. Because I'm following up with another video where there's literally a really prominent YouTuber who shows the cash dividend as like some kind of miracle money payment, and that just flew me into a rage. So let's have a look at some stocks. And I just want to say, I love the comments and people defending investing. I love investing. It's just like the best thing ever. So whether you're a dividend investor, day trader, scalper, just all of it. It's all brilliant. Love it. And some of you are clearly passionate and saying I know nothing, which is great. Love it. So back on my totalrealreturns.com site, it's a really good site. Enables you to compare stocks with dividends reinvested. So it's all in there. So what I did, I sat down and I kept plugging in stocks to try and find dividend stocks that outperformed the S&P. So I didn't find many. I found Visa. So we all know Visa. I found Altria. I think they make cigarettes. I found Machiavelli's, John Deere, Hubbell, Accenture, and MasterCard, so similar to Visa. And then after that, I really struggled. I tried Exxon, Chevy, all your usual J&J, Procter& Gamble, all your kind of Dow Jones stocks, loads from the, I don't know, kind of tried 50. And I could only come up with these guys that outperformed the S&P. So the red line, if you can see this on your screen, is the S&P. And then everything above that are those dividend stocks above. And those are the only ones that I could find that outperform the S&P. So, and that, if you've got those in your portfolio, you've done brilliantly. Some people in the comments said that dividend investing is safer, less volatile. I don't know if I completely agree. All these movements look on par with the S&P, but I guess S&P is blended. It's got 500 components. So it also, I guess, in theory, is quite a diverse portfolio. So anyway, those are the stocks I found. A few guys gave me some more tickers, so we'll just add those. So ARES, I think it's Ares Management, ARCC, and Main. I've heard of Main. That's a very popular dividend stock. So now let's have a look, see how that changes things. So it slightly changed the timeline. It's now set, the most green one. Yeah, so MO underperforms with dividends reinvested. But yeah, that's a great pick. The Ares Management, ARES, someone said it smoked it. And they're right. It has come from a low and it's now at a high. So I don't know why it was underperforming, but you're right. It's now outperforming by quite some way and looks to be very consistent climber. So that's Ares Management. ARC, which is also, so there's Ares Management, ARES, and then ARCC, which is Ares Capital Corporation. So I'm assuming they are similar. And then Main Street Capital Corporation, that's in here somewhere as well, mixing it in. So yeah, the one that I'm going to now remove is Altria MO. That one's gone because that one was underperforming. There you go. So now those are your outperforming the S&P dividend stocks. That's that's from 2014 to 2025. Because remember, it all depends on where you start these things. Again, a lot of hocus pocus online on when you pick your start point. You can make gold outperform the S&P if you pick the right start point. Whereas if you pick the true start point, gold massively underperforms the S&P by so many leagues. It's outrageous. And then I'm sure that's going to get flamed in the comments. People will say gold's outperformed. Yes, but just seriously, look back over a long enough period and you'll just see how gold goes nowhere. So I don't know if that's been interesting. There's highlighting these stocks. I don't need to read them through again, but this site is really cool when you're trying to come to terms with your real returns. Just out of interest, I'm always interested in any company that's talked about. So Ares Management, dividend yield of 2.4%, that one. The Ares Capital Corporation, ARCC, dividend yield of 8.22%. And the Main Corporation, Main Street Capital, 4.78%. So interesting contributions. Thanks very much for those. And I'm sure this will spark more debate. Totally up for more debate on investing and stocks, dividends, you name it. All great stuff. So thanks so much and look forward to the next chat. That's it.